Right. Yes, so we are live, and today's topic is going to be IAS 16. Okay, and we will be starting a new lesson on accounting for non-current asset. So, if we rewind, we were on elements of financial statements, and out of elements of financial statements, we looked at revenue. Now we'll be looking at statement of financial position, and especially the one of the biggest contender or the one of the biggest element in SOFP is the non-current asset. So let's see how we will go and see non-current asset. So non-current asset is not just restricted to IAS 16. There are plenty of standards which aids in recognition and measurement of IAS 16. Sorry, of property, plant and equipment. One thing is IAS 16. Another thing is IAS 23 on capitalization of borrowing costs. Can you tell me more? IAS 20 on government grants, whether they have to be capitalized or they have to be considered as an income. Then IAS 40, which is investment property, another breed of non-current assets. IAS 36 on impairment. IAS 38 on intangible assets, right? We are now looking at non-current tangible assets, but IAS 38 is what will provide recognition and measurement standards for intangible assets. Then there is something called IFRS 5 also. That is, yes, assets held for sale. So we will see how non-current assets are accounted in full and full. It is not just this one standard IAS 16, but rather there is a multitude of standards, and this lesson speaks about all of them. So let's jump in and see. I'll just share my screen. Yes. So accounting for tangible non-current assets. See, the word is tangible non-current assets. Okay, so we will not be speaking about IAS 38 here. Rather, other items, other standards which would help us in accounting for tangible non-current assets. What are those standards? Definitely, the first one is IAS 60 PPE. Then we will look into depreciation accounting, how the assets are depreciated. Then there is IAS 20, IAS 40, and then IAS 23. Okay. So let's start with IAS 60 today, chapter number 4. So this is what we will be studying. We'll just go one by one, but let's jump into PPE. PPE is relatively an easier standard than compared to IFRS 15 because IFRS 15 is a little complex. Okay. IAS 16 is reasonably simpler, but and it is very much tested in the exam as well. Why do they test? Like, it's easy, but the thing is, they would give a lot of information, a lot of situations into just one scenario, so that it becomes a little tricky. There would be plenty of dates involved, there will be plenty of numbers involved, there would be plenty of decoys involved. Now, what is a decoy? They would give a information which is of no use for our recognition, but that would be there to just confuse us as to, okay, should we take this or should we take the actual? So this standard wise understanding the standard is not very challenging, okay, in my opinion. But what is really challenging is doing the questions which comes over the standard, because they make it really tricky, right? So let's go in and see IAS 16. Let's understand the standard, the easy part, and then we will definitely attempt some questions also. IAS 16 covers all aspects of accounting for property, plant, and equipment. This represents the bulk of items which are tangible non-current assets. Okay, so this is only for tangible. That's the keyword. Now, there is an exam focus point also. IAS 16 is a fundamental standard and it is examined frequently. You need to be very familiar with its requirements. Be careful, it can be surprisingly tricky in the exam and can include a range of different issues. This is exactly what I was talking about. In June 23, students were asked to identify the appropriate financial reporting treatment of construction of a large item of land that was partly financed by borrowings and the construction had caused some environmental damage. So there will be plenty of situations. Okay. Remembering the situations is not hard, but when everything comes at one go, the accounting becomes a little tricky. Okay. So let's go ahead and see, IAS 16. Now, what exactly is accounted in IAS 16? What is the scope of IAS 16? IAS 16 should be followed when accounting for PPE, property, plant and equipment, unless another IFRS standard requires a different. So any property, plant and equipment. What is a property, plant and equipment? The definition we will see. But any property, plant and equipment, unless another IFRS standard has a different treatment, okay, specific over general, then IFRS IAS 16 will not apply. Now, what are these specific assets? Biological assets. What are biological assets? Yeah, so biological assets are related to agricultural activity apart from bearer plants. Okay, biological assets are covered in IAS 41 agriculture. So, except bearer plants. So, what is a bearer plant? What is a bearer plant? Hmm? Bearer plant is something which is considered as a PP. Now, let's say that you have a big plantation of grape. Okay, you have vineyards, or let's take an Indian example for this. Let's say that we have a lot of mango trees. Okay, our major business, core income generating business is selling mangoes. Okay, and we manufacture it or we grow it in our own premises. You have acres of land, you have planted a lot of mango trees, and these mango trees can be used for more than one period. Like, they will stay for many number of years, right? And it will bear you fruits. We pluck the fruits and we sell it. So this, ideally, looking at our business, becomes a property, plant and equipment. Okay, it will be more clear once you see the definition of a PPE. But if you have those assets, which are biological, like mango trees or vineyards or tobacco farms, not tobacco farms but mango trees and vineyards, which have a bigger useful life, trees which will have a bigger useful life, and it is used for production and sale, then it would be a PPE. Okay, it would be called as a bearer plant. All right. So can you say paddy is a bearer plant? Paddy would be sliced, the entire thing would be sliced. So its economic useful life is lesser than 1 year. The next year you'll have to plant it again. You have to sow and plant it again. So it's not a bearer plant, but mango trees are a bearer plant. You understand the difference, no? So paddy, etc., would be accounted as per IAS 41. Whereas mango trees is a bearer plant. It can be accounted under PPE. This would be more clear once you see the definition of PPE. Now we're looking only at the scope.
Same like grapevines also can be considered as a biological cell, right? So it can only be used one time.
No, you will only pluck the grapes. You will not slice the whole vineyard.
Huh?
Right? Now the scope will not be extending to mineral rights and mineral reserves as well. Okay, mineral rights, mineral reserves such as oil and gas and non-generative resources. Let's say that you have an oil well. Okay, or normally what happens is you can never have an oil well. These are owned by governments. Okay, the property of any landed property or any natural resources would belong to the government. You would be given a right to mining, right? You would be only given a right to mine, or you can use this particular thing on lease for, like, X number of years. So this would be the arrangement. You will not get the ownership of it. So any mineral rights, mineral reserves, mineral rights means you have rights to extract. Okay, and mineral reserves such as oil, gas and other regenerative resources, it would only be by IFRS 6, exploration and evaluation of mineral resources, which I don't think is an examinable standard. Okay, it's very specific to certain businesses. And of course, PPE, that is classified as held for sale. Okay, which are classified as held for sale, it would be accounted as per IFRS 5. The recognition and measurement of PPE does not apply there. Okay, that's a separate standard. We will see how or when a property, a PPE, is classified as held for sale. Okay. So see, again, they have given a thing of bearer plants such as grapevines, rubber trees. See, the tree never goes. You will only extract the sap. And oil palms are within the scope of IAS 16. Bearer plants are living plants which are solely used to grow produce over several periods and are not themselves consumed. See, you will consume the mangoes, but you will not consume the mango trees, right? Being usually scrapped when no longer productive. They are measured at accumulated cost until maturity and then subject to depreciation and impairment charges. We will look at the recognition and all differently. But at this point of time, I want you to understand that bearer plants. What is bearer plants? Those which have a significant economic life and which you are not consuming the plant. Rather, you're only consuming the produce from the plants. In such a case, you have to identify bearer plants. The plant itself is consumed, then it will not be a bearer plant. It would be as per IAS 41. Okay, just keep this in mind. Is this clear till now? So what are these things which are not under the scope of IAS 60? Yeah, agricultural, IAS 41 except for bearer plants. Then mineral rights and mineral deposits which are under IFRS 6. And also once a PPE is classified as held for sale, then it will be accounted as per IFRS 5. We will not be depreciating it and etc. So those things will happen. Okay. Now let's see the definitions. Now we will come to understand what is a PP. What is a PP? PP are tangible assets. Okay, never an intangible asset is never a PP. PP is tangible assets that are held for use in production. Okay, or supply of goods or services for rental to others or for administrative purposes and are expected to be used during more than one period. Okay, I think you might be very aware of this definition. So, can you give me some examples then? Are held for use in production? Can you give me some examples? Machinery, plant and machinery. Okay, plant and machinery in a manufacturing sector. Then these should be tangible assets which are held for use in production or supply. Okay, for supply of goods and services,
Vehicles.
motor vehicles, right? Or if you're using some equipment for supply. For rental to others, obviously it should be building or like, any other things which is for rental to others or for administrative purposes also. Okay, it's like furniture that you're sitting on, the printers that you're using, and it shall only be classified as a PPE if it is expected to be used for more than one period. So what is a cost? Cost is what I pay at the time of acquisition. Okay, so let's say that at this, so whenever we use the word cost, henceforth, I purchase this for X. Okay, that would be cost. Whatever is accumulated depreciation, etc., will not do. Cost means what is the initial price at the time of purchase. What is residual value? I think you guys know this. Don't go by the don't spend time reading the definition, but rather like tell me what you understand when you say residual value. Okay, so yeah,
At the end of its life, how what valuable it
Proceeds of.
absolutely.
Scrapper.
Yeah, scrap value at the end of its useful life, if it has a market where I can still sell it, then that is called the residual value. Okay, so a residual value is net amount which the entity expects to obtain for an asset at the end of its useful life after deducting the expected costs of disposal. Okay, you have to deduct the disposal cost also. So let's say that I have to also carry this old asset to another premises. Then fair value minus that would be residual value. Okay. Now, what is an entity specific value? Now, this I don't think might be something new. I mean, it was new for me. So, what is entity specific value is, let's say, what is the present value of future benefits I'm going to get by holding this asset? Okay. So, if I have an asset And of course, if it is an asset, it should give me some economic benefits, right? So what is the future present value of future economic benefits? Then that is the entity specific value. Entity is deriving so much of value from this asset. Okay. So entity specific value is the present value of cash flows an entity expects to arise from continuing the use of an asset and from disposal also. I mean, future benefits includes value at the time of disposal at the end of the useful life or expects to incur when settling a liability. Okay. So that is that. Carrying amount is what? Carrying amount is cost minus accumulated depreciation. And why we use cost minus accumulated depreciation? Cost is always the initial acquisition purchase price. Yes. Impairment loss is the amount by which the carrying amount is what? Asset cost minus accumulated depreciation exceeds its recoverable amount. Okay.
Yeah.
We will see impairment in IAS 36, but I think this is fairly understandable. And a bearer plan, they have given another definition for that as per IAS 16, para 6. And bearer plant is a living plant that is used in the production or supply of agricultural produce, right? Is expected to bear produce for more than one period and has remote likelihood of being sold as agricultural produce except for incidental scrap sales. Okay, I'm not going to sell my mango trees. But incidentally, if let's say there was a lightning and it kind of fell down, then I would sell the wood for whatever is the price. Yeah, but definitely it cannot be consumed, it cannot be sold as an agriculture. I can't sell a tree as an agriculture produce, right? And I have to sell the adjoining land also. Okay, so it will not be done. Fair value is the price of that asset or a market value of asset, and we use IFRS 13 to find that. Is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction, only in arm's length, between market participants at the measurement. Okay. Now we know what is the scope of PP, of scope of the standard. You know what is definition of major items, especially definition of PP. Can somebody tell me what is the definition of PP? Okay.
Administrator.
Or for rental to others.
For more than-
Expected to be used for more than one period. Just keep that definition in your mind. So what you have to see is, first thing is an asset should come into the definition of a PP. Okay, while recording something, I made a purchase. To for record this, first thing I have to use is, uh, it should satisfy the definition of PP. What is the definition of PP? It should be a tangible asset that is used in production or supply of goods and services for rental of to others or for administrative purposes and expected to be used for more than. So this changes. Okay, so let's say that I am a person, I am my culture or my my whole mentality is that I'll buy a phone, I'll use it for 5 years, and after it is no longer usable, the company only stops, then I will scrap it. But you might be a person who will buy a phone every year. So you'll buy iPhone 17 now, you'll buy iPhone 18 next year. So in that case, it's not a PPE for you, but that same phone would be a PPE for me. Okay, so you have to look at it is a principle based standard. That's the beauty of IFRS, right? But you have to it gives a lot of flexibility and leeway. It doesn't say that now if the same thing goes with the US gap, it will say phone expense. It's a rule based. Okay, you clearly know what to do, but this is a principle based. Okay, this is the difference. Now, once you identify that it is a PPE, then when do you recognize this? Okay, that is called recognition. When do you recognize it? Okay, in this context, recognition simply means incorporating the item in business's accounts. Okay, in this case, as a non-current asset, the recognition of property, plant, and equipment depends on two criteria. Then you have to look at two criteria. One is it is probable that future economic benefits will be associated with the asset will flow to the entity. Okay, so let's say I bought an iPhone, but it is not working. Sorry. Even though it satisfies the definition of a PPE, it does not have any future economic benefits for you. The cost of the asset can be measured reliably also. Okay. Then only you will account, you'll recognize as a PP. One is definition, then there is recognition. So when do you recognize?
And the future economic benefits.
It is probable. You can't just say if it's certainty now, but it is probable. Of course, I'm going to use this phone for all my correspondence. It's got to give some probable economic benefits associated with the asset will flow to the entity, and the cost of the asset to the entity can be measured reliably. Okay. Now let me ask you a question. So let's say that in the definition it says for administrative purposes also, right? Which includes furniture and fixtures and even if a painting. Okay, I buy a painting. It does satisfy the definition of PP. It's used for I'm keeping this painting in my office. It satisfies the definition of PP. But should you record it as a PP? Is it probable that future economic benefits associated with the asset will flow to the entity? So what will you account a painting as? Or let's take a very Indian example. Okay. Whose fan are you? Yuvraj, MS Dhoni. Okay. MS Dhoni kind of like, hit the winning 2011 World Cup. Okay. That bat is on sale. So what you did, you being a big MS Dhoni aficionado, you bought it and kept it on your cabin. You're a big boss. Okay, you're doing an accounting or consulting firm. You kept it on the back of your cabin. So everybody who comes in will say, wow. Right? Now, does this meet the definition of PPE? First thing is, no. Meet the definition of PPE. It's used for production or supply of goods. No. Huh? For rental to others, no. For administrative purpose, yes. Because I'm keeping it in my office, right? For administrative things. Same like a furniture or a decoration. And it is used for more than 1 year, definitely. Now, when it comes to here, it is now when it comes to recognition. Can I recognize that as PPE? Why?
The cost of the subsidy cannot be measured here.
The cost can be measured reliably. I paid so much of money on the auction to purchase this bat.
But no future account.
Future economic benefit is zero because client will come based on that.
See,
That shows it.
nobody sign an engagement with us.
We said that we will then
That is okay.
that can be.
But I am not selling this, man. I am a big MS Dhoni aficionado. No selling till death.
It's sold for the end of the what's the difference?
Mhm.
I think it is standard.
Is it probable that future economic benefits associated with the asset will flow to the entity or not? The answer is yes.
Yes.
It would definitely be there. Now think of it, guys. So let's say that in if we take the same, like there should be something flowing in. If you take that idea into mind, then everything. Let's say that you are doing a lot of. Now you're renovated an office. You've kept a lot of fixtures, which is going to be used for more than 1 year. Is there any direct economic benefit that I'm getting from that? No. Okay. But if we don't have this office, if we don't have this, everything, where will you do our consulting business? We'll do it on the road. Now, if we are going on the road and keeping a banner and asking for consulting service, do you think that any client will sign in?
But that is a basic requirement അല്ലേ ഇപ്പൊ ഫർണിച്ചർ ഓഫീസ് എന്നൊക്കെ പറഞ്ഞാൽ അങ്ങനെ ഓഫീസിൽ
I'm asking the recognition only, whether it can be a PPE as per IFRS or not. Right. Now, where will you do your business? Can you go to the road and do? No. So, all these things have an economic benefit. Because we have an office, because we have fixtures, because we have something like this, I can woo the client. Right. Don't always think about whether you have a direct. Without an office, without administrative office, we have to kind of like, do it on the road. That's not.
Still we can do business now, even if there is no office.
No, correct. But because we are
Oh.
having an office, we can get better clients.
Yeah.
So there is a future economic benefit.
It's all of the fixtures essential, but if I wanna take that as well as into my assets, seems
അത്
reasonable.
I paid so much of money for it. I'm gonna use it for more than and it's kind of my
Did you pay money from the companies?
yes. I bought it in the name of the company. So it's not a personal asset. So we are not talking about taxation here. We are talking about accounting. But nevertheless, yes, we paid from the company's behalf. But yes, if I let's say that tomorrow another person comes, he's a client comes to have a discussion. He sees this, but he is also a big MS Dhoni fan. Chances are that I will grab that contract at a very higher price than anybody or any one of my competitors. Correct. That is why you miss the keyword. It is probable that future economic benefits associated with the asset will flow to the entity. Isn't it probable, the situation that I told you? It's not judgmental, it is probable. No, there is a probability. Okay, then where would you record such an asset?
PP അല്ലാത്ത separately
Tell me which standard. Or tell me.
investment.
I am not keeping it for selling. And it does not have a
ഈ സാധനം suppose we are selling it പറയുന്ന കാശ് കിട്ടുന്നു.
investment property. I have to lease it to somebody,
Investment property അല്ല investment asset. Investment property.
No, it's not investment. I want to I've told you before, I am a big fan. I'm not intending to sell.
Okay.
No, it's my dedication and thing to this person. It's inspired me a lot.
അറ്റ്ലീസ്റ്റ് ഇപ്പോ ഓഫീസ് ഇല്ലാണ്ട് ഒരു ബിസിനസ് നടത്തുന്നു. ഓക്കെ, അയാൾക്ക് ഓഫീസ് ഇല്ലാണ്ട് ഒരു ബിസിനസ് നടത്തുന്നു, ഓഫീസ് ഉള്ള ഒരാളുടെ ബിസിനസ് നടത്തുന്നു. നമുക്ക് എക്കണോമിക് ബെനിഫിറ്റ് മനസ്സിലാക്കാൻ പറ്റും. ഓക്കെ, ഇത്രയും ആ വ്യത്യാസം മനസ്സിലാക്കാൻ പറ്റും. പക്ഷെ ഒരു ബാറ്റ് കൊണ്ട് വെച്ചെന്ന് പറഞ്ഞിട്ട്
അല്ല അത് അങ്ങനെ പറയുന്നില്ല. ബാറ്റ് വച്ചുകൊണ്ട് നമുക്ക് കിട്ടാനുള്ള ചാൻസ് കുറച്ചുകൂടി കൂടുതലാന്ന് പറയുന്നത്.
Is it probable tomorrow there is a big CSK fan coming and sitting here, or a big Dhoni fan coming and sitting here? Probable. Yes. Or let's say that
നമ്മുടെ ഓഫീസ് ചെന്നൈയിലാണ് വെച്ചോ, അവിടെ ആണെങ്കിൽ
Yeah.
100% okay.
No, it's probable. That's what only you have to estimate. Whether this is probable, yes. Then I can.
Then what to depreciate it?
Yes.
Drawings അതൊക്കെ എല്ലാം like
I am not saying ellam. My question is again, I'm stressing the thing. It's a principle based standard. For meeting this, he may treat it as an expense. The other person can treat it as a asset. Only thing is we have to understand how is it probable that future economic benefits associated with the asset will flow to the entity. If it is not probable, it will be expensed off.
Okay.
Purchase for decoration, right? Tomorrow if there is an audit, you have to just say that no, it is probable, it is a good thing, it is a fantastic thing, and it is giving me business. I signed Muttaya Muralidharan. Tomorrow what is the high chance that even MS Dhoni will come and he will get info? Wow, so you're a fan, so that means that I'll get some personalized work done by you. What, I have a guaranteed chance that I can sign himself as well. He's a big businessman. Anyways, okay. So you have to recognize when it is probable that future economic benefits will flow, and also the cost of the asset can be measured reliably. Okay. Normally, what I do is I ask this question in every interview. And
ഇപ്പൊ നമുക്ക് റിനോവേഷൻ ചെയ്യുന്നുണ്ടല്ലോ ഇവിടെ. അപ്പൊ നമ്മ മാറുമ്പോ ഇവിടെ ഈ ഓഫീസ് പെയിന്റ് ചെയ്തു. ഓക്കെ, പെയിന്റിങ് കോസ്റ്റ് നമുക്ക് ഒരു കോസ്റ്റ് ഉണ്ട്, ഉണ്ടല്ലോ അഡ്മിനിസ്ട്രേറ്റീവ് കോസ്റ്റ്. നമുക്ക് ആ പെയിന്റിങ് മാത്രമായിട്ട് കാണിക്കാൻ പറ്റുമോ A16?
no, see, my point is pretty simple.
അല്ല, പ്രോബബിൾ ആണ് ഫ്യൂച്ചർ എക്കണോമിക് ബെനിഫിറ്റ്. ലൈക്ക് എന്ന് വെച്ചാൽ ഇനിയിപ്പോ പണ്ട് എംപ്ലോയീസ് വരുമ്പോ അല്ല ഓഫീസിലേക്ക് ആൾക്കാർ വരുമ്പോ
I am using the paint for my administrative purpose, or I'm using the wall for my administrative purpose. In the definition of PPE, Is it the wall or the paint? Is it separately identifiable?
Yeah, okay.
No. See, end of the day, I'm not saying you're right or I'm wrong or I'm wrong or you're right. The thing is, it's principle based. If you can satisfy these definitions, you can. But in your specific example of a paint, I don't think so. Because it's not very specifically identified.
Paint നമുക്ക് കാണിക്കുക ഡിപ്രിഷിയേറ്റ് ചെയ്യുക.
No. See, there are two things. We will come to that. So first of all, I would already have painted. Correct. Now you're adding repainting it. Now that is called subsequent expenditure. Okay. Whether it can be capitalized or whether it needs to be expensed, there are other guidelines. Let's have this discussion when we come there. Okay. So these recognition criteria apply to subsequent expenditure as well as cost incurred initially. There is no separate criteria for recognizing subsequent expenditure. For example, if a shop building is extended to house a cafe or other revenue source, this meets the criteria of future economic benefits. And I was just telling you that we will reach subsequent expenditure. We'll actually reach there. Now, what is meant by subsequent expenditure?
That expenditure results in bringing economic.
No. Wait. So I'll give you an example. So let's say that you have a bike. Okay. Now, and you are doing a repair of the bike. It broke down and you're doing a repair, or you're just doing a general repair. Can I capitalize it? Can I add it to the cost of bike, which is already my PP?
Other enhancement or other future, other than the extra benefit, only you can.
Exactly. So what it says is we have to get an extra benefit by doing this. Okay. Either my, it reduces cost or it gives me additional money. Unless a specific,
Just a
economic benefit can be identified, we cannot capitalize it. Okay. Also, even if there is an economic benefit, but you have to do it every year. I mean, if it does not have a life of more than 1 year, then also we'll not capitalize it. So that's what they're saying. Even for subsequent expenditure has to go through these two. There is no separate thing for subsequent expenditure. Okay. So let's say that I bought a car. Car has a useful life estimated for 15 years. Some component broke down, suspension broke down, and suspension is now refixed. Let's say car has a useful life of 15 years. I am in my 7th year. My suspension is gone. Okay. Now, can I kept new suspension gear. Can I capitalize it or can I not?
which useful life കൂടും.
No, 15 years only. Car, you see, the useful life of the asset is not based on the component. It's based on a lot of other things.
But it will stay more than a year.
Yeah. Yeah. So in this case, you will expense it out, not capitalize, because future, it is not probable that, the suspension is going to give you any future economic benefit. Car,
If it increases the life, then
see,
right.
I don't understand when you say that it increases life,
Yeah,
because it will
no,
never.
but-
Car itself, engine, everything combined, let's say if I say that it would only have a useful life of 15 years, then even if the suspension is running after 15 years, I will definitely, yeah. So when you change a component, if it is not giving you any future economic benefits, okay, car is going to give you the same mileage, car is going to run in the same way only that you change the suspension. Even if it's a significant addition or there is even an addition of an asset being done, it should be expensed because future economic benefits cannot be identified. Okay. So that is what is called subsequent expenditure. Now let's come to your painting thing. Taking that example, you tell me what is the future economic benefit I receive from changing the paint?
ഇതിന്റെ കേസിലുള്ള ഇപ്പം സസ്പെൻഷൻ ആ കേസിൽ ആക്ച്വലി when we I don't use suspension, okay. So the performance of the vehicle will be increased compared to the previous one.
Okay.
So in that case, it's a benefit, not extra.
No, if you can directly identify all that, it results in extra money to me or it will result in and savings in cost, then I can capitalize. So just because I change the suspension, I'm not changing the engine or other things in the car. I don't think the mileage will improve. Only that while jumping, it would be a little. Aha. So you can't directly identify any future economic benefit. Right? Car will run. To maintain the same car which I did for which I accounted had which I estimated to have a financial, I mean, useful life of 15 years, I had to do this repair. So it is an expense. It's not something addition that I did. You bought a car, it will run for 15 years, it's your estimate. Okay. If it does not, then you have to account it only as a, if it does not reasonably creates any difference in economic benefits in terms of anything, okay, then you have to expense it out. So subsequent recognition. Okay. Now there is another thing called replacement accounting or component accounting. We'll come to that. But now let's come to your paint example with that logic.
Same. Very expensive.
Absolutely. What you have to really see is whether would it result in a further economic benefit. Now the bat will definitely, it's a new addition into the wall. And seeing that I may get. Seeing the paint, I don't know. Okay. Now, right. So they are now explaining the further benefits. Okay. And the future economic, there are two conditions for recognition: future economic benefits associated with the asset, probability of future economic benefits, and the second one is cost can be reliably measured. Now, the degree of certainty attached to the flow of future economic benefit must be assessed. This should be based on evidence available at the date of initial recognition. Okay, usually the purchase date. The entity should be assured that it will receive the rewards attached to the asset and it will incur the associated risk, which will only be generally be the case when rewards and risk have actually passed to the entity. Until then, the asset should not be recognized. Okay, so first thing is the risk and rewards along with the assets should be transferred to you. The PPE should be completely in your control. Number two, it should be probable that it would get me some future economic benefit. Okay, then only you can account it. Second criterion, cost measured reliably. It is generally easy to measure the cost of an asset as the transfer amount on purchase. Correct? I buy a car, I pay X amount of money. That is the cost. That is what was paid for it. Self-constructed assets is the one. So even if it is a self-constructed asset, can also be measured easily by adding together the purchase price of all constituent parts, labor, material, etc., paid to external parties. That is when there is a little confusion, but that also if you can relate what is directly attributing to the asset when it comes to labor, materials, etc., you can add that up and you can see. Okay. Now, in a self-constructed asset, if you say that I have a person, I'm paying him salary, and he's doing this construction also, he's doing my thing, then it is not. Then you're saying, okay, 60% of his work is that, or that may not be reliable. So that cost should not be added. But what is directly attributed, even if it comes from a self-constructed asset, we can. Now let's say that this person is exclusively working for that. Fantastic. His salary would also be capitalized. Okay, so material, labor, etc. Now we will come to separate parts. Okay, component accounting. Most of the time, assets would be identified individually, but this is not the case for smaller items such as tools, dies, and molds, which will sometimes be classified as inventory and written off as an expense. That's okay. Major components of spare parts should be recognized as property, plant, and equipment. So if it is a small item, even if it's a PP, let's say I bought a calculator. Calculator, I'm using it in my administrative work or used in production or supplier services. It has a useful life of definitely more than 1 year. But if it is a small item, you can write it off as an expense. Okay, based on materiality. You don't need to capitalize it and calculate depreciation on an asset which costs 20 dirhams. Right? But however, major components and things like laptop, however, should be recognized as PPE. The point that they're trying to derive in para 8 is that you can have a stint of materiality, even if it's satisfies PPE definition and recognition criteria. There should be a sense of materiality in recording. You can record that as an asset. You can record, say materiality threshold, and I expensed it off. That's fine. Now, very large and specialized items, apparently a single asset should be broken down in its composite parts. This occurs when different parts have different useful life and different depreciation. Let's discuss that a little bit. Now, this is called component accounting. Yes. Component accounting. Now, what does it mean? Sometimes what happens is, see, each asset has to be depreciated, right? So I buy an airplane or a ship. Okay. Now, what happens is this would have so many components, correct? It would have what? It would have an engine, propellers. Then there would be, if you look at inside, there would be seats, right? Then there would be braking or landing gear, right? Now, problem is the airline manual says that you can't use an engine for more than 5 years. Of course, there would be the body of the plane also, right? Now you can't use your engine for more than 5 years. Every 5 years, you have to change the engine for security reasons because there are a lot of crashes happening these days. This is mandatory. Propellers, you have to change every 8 years. Seats, you have to change every 2 years because COVID is coming, people are coming and going. Seat and all, you have to kind of change every 2 years. Landing gear, you can have it is okay, it is very good. Body of the plane is also something which will go for 15 years. Right? Now, in such a scenario, you paid around let's say 450 million for the plane. Huh? You paid 450 for the plane. And for the plane, I need all this. I'm not buying these individually. These are not individual, assets. Right? I will buy the plane from Airbus or Boeing. I'll buy the plane for 450 million. It would be having all these things, but each thing has its own separate life. So can I say that, okay, body of the plane has 15 years, so I will depreciate everything in 15 years? Hmm? Yes or no? So the engine may have to be replaced, right? So I would just choose its useful life as 5 years, and whatever is their useful life, we would only be accounting based on that. So what I'm going to say is, even though I paid 450 million to purchase an airplane, I would record it in PPE as 5 assets instead of one asset. And I would be depreciating it accordingly. Clear? I will not be depreciating the entire asset. Instead, I would be if it is having various useful life. We have a legal mandate to say that engine can only be used. I can't just depreciate for 15 years because I would do a change also, no, after 5 years. So the accounting would be wrong. So you would have to depreciate each, you have to identify and recognize each component separately. Clear? If it is so clear, I'll ask a question. Exactly. How much? Because if I'm recognizing each of them separately, what is the, yeah, At what price? What would be the cost? Exactly. I paid 450. Can I? What to do? What to do? This is not IFRS 15.
We proportionate based on the number of years. No.
How can I apportion 450 into 5, 8, 2, 15 and 15? It's not. An engine, I will not pay for the engine 450 million. No? I will only pay for the entire flight coming. So what they are saying is here, it's not standalone price, but good one. But it is, you have to take the current replacement cost of this asset.
The market price.
Current market price. But replacement cost, I told you, includes the cost of bringing it. So you have to take the current today. If I have to replace the battery, how much would I pay?
Mm.
So you have to take the current replacement cost. So replacement cost as on which date? The date when it is coming in as PP. Okay. You have to take the current replacement cost and see. So let's say that the current replacement cost of this is 150 million. For the propeller is 50 million. For the seats is 20 million. For the landing gear is like 10 million. Rest of the body of the plane will be allocated is equal to 450 minus 200, 230. This is how the accounting. Okay. And now you have so many assets and you will depreciate accordingly. Even though it's one asset with one utility, in certain assets, when it is big, you can use component accounting as well. When do you use component accounting? What is the if it is given in the question, how do you pick that? Okay, this might go into component accounting. How do you pick it? What is the indicator which says that component accounting may have to be used? Exactly. They will say, you bought a car for 15 years, but the engine only has a useful life for 5 years. The trigger should come that, oh man, I will have to record it differently. Good one, Melvin. And I will have to find what? Look for the current replacement cost, not the replacement cost at the time after 5 years. You have to look at the current replacement cost. Okay, so this is a little overview on component accounting. These guys have not really explained it, specified it very well. This is a problem with this textbook. And of course, Kaplan, if you can manage, that would be a way better textbook than this, because these things we'll have to go out and find, like, even if it is there at what price, etc. So very large and specialized items, and apparently single asset should be broken down into it composite parts. Because of course, when the different parts have different useful lives, and different depreciation rates are applied to each part. Similar aircraft with the body and engines have. So be very careful. Pick this up. Can you get my charger? I'm just running out of juice. Yeah, not C type. This is pin.
This is
I don't think so. Oh, okay. Works. Thank you. Okay. So did you understand separate items? It's not very clearly in this textbook. Okay, so even if you're trying lengths and breadths to buy this textbook, I would say it's not that good, because they are just quoting IFRS. But to understand what it means, we have to do a little digging. Now, safety and environmental equipment. Now, what is a safety and environmental equipment? Hmm? Can you give me an example of safety and environmental equipment? Yes, environmental concerns, or like, these mandatory carbon cans, what do you call it? Fire extinguishers, which is put. So these are safety equipments. Would these safety equipments be considered as PPE? It's technically not used for administrative purpose as well. This furniture I'm using for administrative purpose. These chairs I'm using for administrative purpose. Like when I comes, that is not technically used for production or supply of goods or for administrative purpose or for rental for others also. Can I say that those are PPE? So what happens is, like, the IFRS 16 para 11 specifically says these items may be necessary for the entity to obtain future economic benefits from its other assets. For this reason, they are recognized as assets. Tomorrow, if this burns, only that can come and help. So it will help me to earn future economic benefits from my other assets. So, however, the original assets plus safety equipment should be reviewed for impairment. Okay. Sometimes what happens is the equipment itself would have a safety, right? So they're asking whether that can also be capitalized. That's just kept in case of any damage. What's that saying is that equipment may be capitalized because in case if this goes down, he is the only one who can help us attain that full economic benefits which we accounted for. Okay. So that is recognition. Did you understand recognition? Then tell me what are the things we kind of looked at recognition. Wait. So recognition, first I told you have to look whether it satisfies the definition of PPE. What is the definition of PPE? You. Okay.
That provides it's used for production or supply of services, administrative purpose,
For rental to others.
and more than one.
Expected to be used for more than one accounting period. Fantastic. First, you have to see the definition of PPE. Then you have to see two things: whether there is probable future economic benefits, and the cost can be reliably measured. Right? Then we saw some permutations and combinations also. What are the permutations and combinations we saw? They have clearly given where bearer plans should be recorded or not. Right? Then, yeah, subsequent expenditure. When do you account subsequent expenditure on the asset? When it actually gives you a future economic benefit. Right? Now there is component accounting also. Now tell me, I'm not selling the full plane, but I am replacing the engine after 5 years. Would it be capitalized? That engine be capitalized? Because it is a separate asset. Okay. It would be capitalized provided the previous asset is de-recognized. Okay. I can't just keep both. You have to de-recognize the previous asset and recognize the new asset when you are doing component account. Then safety equipment. See, in this context, don't go by the firing extinguishers. They means the asset, if you buy, would also have a safety equipment. Whether that is also PPE is what is the answer. Then what did we learn? I think that's it. And also, the component of materiality. In case of smaller assets, you can use the probably the materiality concerns like calculator and stuff. So these are the items which we discussed. This is recognition. Now, once you have recognized that okay, this is a PPE, I'm going to record it. What is the next thing you will do? Absolutely. Measurement means at what value? How do I measure the value which I will be capitalized? Okay, you tell me if you need a break. Huh?
Yeah.
So let's see measurement. So there are two types of things when it comes to PP. Okay. PPE. First, you have to say initial measurement. Initial measurement means the measurement at the time when I purchased. That has to be done always at a cost basis. That means you have to identify the purchase price. What is cost? Purchase price. You have to identify the cost. Okay, there is no other no way at all that you can do an initial measurement. You can only do on a cost basis. Now, how do you determine what cost to add? Okay, let's read this. Once an item of PPE qualifies for recognition as an asset, it will initially be measured at cost. Okay, the standard lists the components of the cost of an item of PPE. What would be components? Purchase price. You have to deduct any trade discount or debate that you use. Okay, actual purchase price less discount, import duties, and non-refundable purchase taxes. Why they have specifically said import duties?
Not everything is directly available. You can send it in.
No, I understand that. But why import duty? And no, because it's a non-refundable tax. You will not give back customs. You may, whatever else you will be billed at, like say GST or something, you can get back. So that cannot be added to the cost of the asset or any non-refundable purchase taxes. And directly attributable cost of bringing the asset to working condition for its intended use. So what could be the direct cost? Site preparation, initial delivery, installation cost, testing, professional fees, whatever you incur to bring the asset into its ready for its intended use. And an initial estimate of unavoidable cost of dismantling and removing the asset and restoring the asset. What is this?
From purchase time to restore it.
I am not spending any cost now.
So they're estimating it. Now we make this equal. We have to take it down when we take it back. Anyway.
At the time when I am disposing. So that time I am estimating some dismantling costs.
That should be in provision now is 37. It's not in that. Yeah, they're showing us an asset.
No, it is a part of PP. Not just installation, but if I incur any cost of dismantling, the present value of it should be capitalized right now. But it would be a provision also. See, you will get that once you understand the journal entry. Okay. So let's see. So what are the initial measurement? What are the components? Purchase price. Then non-refundable taxes, which includes then directly attributable cost and cost of dismantling. Estimate. Okay. Now, let's try the journal entry to alleviate your doubt. Okay. So let's say the purchase price is 100. Okay. Non-refundable taxes is 10. And directly attributable cost additional that I incurred is 200. Okay. And now there, let's say the estimate of dismantling, say I'm going to dismantle the entire thing after 20 years. At that point of time, I'm going to incur 2000 or 200. So first thing what you have to do, you have to find the present value. I'm incurring this 200 when after 20 years. So what formula will I use to find the present value? So this is not a cost I will incur today. This is a cost I expect to incur 20 years afterwards. So definitely time value of money is everything, right? So what is the formula? Okay. The future cost, okay, divided by 1 plus what is your incremental borrowing rate? Whole raised to whole raised to 20, right? This will be the formula. And once you find out, let's say that this is something around 40. Now you tell me a journal entry. You tell me the journal entry. Tell me the journal entry. What's the item? Asset account debit. And let's be behaving like real students of IFRS. Okay. Yeah. Okay. Let's say that and what is the amount? Okay. So 100 plus 10 plus 200 is 310 plus 40. It would be 350. Right? Then there is bank or AR. Correct? How much? 310. AP. Sorry, my bad. AP. What is the remaining 40 going to? Huh? Where is the remaining 40 going to? You will recognize provision of 40. Right? Now, this is at the time of initial recognition. We will not be recording any amount of this dismantling cost in my initial thing. But what happens to the provision year one? What will happen for year zero? My provision amount is how much? 40. Correct? Now year one, what I will do? 40, whatever is the balance, right? Balance into the discount rate used. So this provision will build up, build up, build up, build up, build up, build up. Every year, whatever is the opening balance, closing balance of previous year, I will multiply with this R. And by the time, if at year 20, what will be the value of this 40? And now I'm paying the dismantling costs. So what would be the entry? Provision would be debited, bank would be credited. So is there a reference of IAS 37 coming here? Yes, only that we are focusing on this, not 37. This is how that will be. So this extra, this balance into R, what would that be? Not interest, it would be dismantling cost or every year first we'll add it into the cost and into the asset, and then whatever after the asset is ready for use, whatever would be incurred would be expensed. Okay, is that clear? Initial estimate. Now IAS 16 provides additional guidance on directly attributable cost included in the cost of an item of PP. These costs bring the asset to the location and working conditions necessary for it to be capable of operating in a manner intended by the management. Any proceeds relieved from selling items made during the testing should be, this is okay. Anything that is incidental to the construction or development of an item of property should be recognized as profit and loss. it should be directly attributed. Cost should only be capitalized. Anything which is incidental should be expensed off, or if it's an incidental gain also, it should be credited to gain. Okay. The following costs will not be part of the cost unless they can be attributed directly to the asset's acquisition or bringing into its working condition. Administration and other general overheads. Okay. Let's say depreciation of this table. If it's not directly attributable, unless this table is kept there, right? Startup or similar pre-production cost and initial operating losses before the asset reaches its planned performance. There would be normal losses, right? So all that don't capitalize unless you can directly attribute it to a product. What is meant by this initial operating loss before the asset reaches planned performance? So let's say that I, change the suspension in my car. It takes a little bit of time for the suspension to come in force, right? So the car is initially giving me, so let's say this is a machinery. Machinery normally gives normal output is 100 units per day. Because I kept the new machine, because it has to kind of gel well, it will only give me 80. So I'm having a loss of 20. No? Unless you can directly attribute that 20 because of this new asset, you cannot capitalize. Okay. Because that might be due to different reasons. That asset might be working perfectly. But another asset is the combination is what is not right. So it can't be directly attributable to this particular thing. So that 80 will expensive. You want to take a break and continue? So we'll stop here. Okay, we'll just read this and we'll stop at subsequent expenditure. In the case of self-constructed assets, the same principles are accounted for as acquired assets. If the entity's normal course of business is to make these assets and sell them externally, then the cost of the asset will be the cost of its production. This also means that unusual costs are excluded from the cost of the asset. Right? It should, even if you're self-constructing an asset, only the directly attributable cost should be taken into consideration. And unusual costs like labor downtime, strike, all those things don't include in the cost of the self-constructed asset, just expense it off. Okay. Key word here is what is directly attributable to the product. So what cost would you kind of components, what would you put it in measurement? One is purchase price, import duties and other non-refundable taxes directly attributable, because the key word is directly attributable. It would be very easy for you to identify. It won't be hard. Okay, directly attributable to the exactly directly attributable to bringing the asset to its intended use. Now I'll give you an example for that. So let's say that you bought a machine. Okay. You bought a machine and you install the machine, everything is ready. But the government says there is a legal mention that employee should be trained in how to use that machine. Then only, or employee should also be trained. No? Now, isn't that cost directly attributable to that machine? Employee training costs? Yeah. So can I capitalize that? Why?
Machine. No. Without the training, we cannot use that.
No. We are, of course, people have to know. No?
It's the government policy, no, but
Let's assume that government policy and all is not here. Sorry for bringing that up. So let's say that you are giving training. Without the training, my employees will not know how to exactly use the asset. It will not be giving me any economic benefit unless employees are also trained. So can I capitalize or not? First of all, is it directly attributable to the asset? They're only been taught about this one asset, nothing else. Is it directly attributable to the asset?
no, actually says that the asset should be linked to the working condition. No?
Correct.
So even if we are not provided the training and everything, it should be
So should it be capitalized or expensed? Do you have any other thing? It is let's assume it is directly attributable to this asset only. Okay. This employees are taught how to handle this asset. It's directly attributable. Should I capitalize or should I write it off? Expense.
I'm thinking, in order to make it in a working condition, what make this.
I mean, otherwise nobody will know to operate this thing. It would be just like dead junk which will be laying there. I can't do it. My employees can only do it. Say, for example, royalty range. We got that. Unless we get a training as to how to use, or unless you guys know how to use it, we have no use with that. Right? It would be a dead junk. So, can I capitalize as training cost? Hmm?
Professional fee, architect, engineer, finance, full category.
Okay. So, Ashik says no. Fine.
Because my thing is that the asset is already under the working condition. And it's already available for use.
Okay. So, in this expense or expense? Yeah, it has to be expense. I'll tell you why. And you're right. Directly attributable cost of bringing the asset to working condition or its intended use. Basically for installation and etc. they need professionals to install that and all. No? So let's say I bought a printer. I need somebody to install that. That is directly attributable and that is needed to make the asset into the intended working condition. Asset is ready for intended use. But if your employees does not know how to use it, then this cost is only improving the know-how of the employees. It is not going into making the asset ready for intended use. Okay. So training cost, normally if you see, you have to expense it out. Because it is to train the employees. No, I'm not doing any value addition on the asset. So why should it be capitalized on the asset? This is the question. This is the logic. Okay. Right. We will continue later then. Okay. So thank you guys. And we will continue from 1.6.2 subsequent expenditure.